Small Business Committee, Mr. Roger Williams of Texas.
Thank you, Mr. Chairman. And Chairman, it's good to see you. Always good to have you here. In past congressional testimonies, you've repeatedly stated that you support protecting the state-based system of insurance regulation, which is the most effective and competitive in the world. In my home state of Texas, is the world's 7th largest insurance market, proving the success of this system. Now at the International Association for Insurance Supervisors Conference in November, there is the opportunity to have the U.S. state-based aggregation method become formally recognized as comparable or equivalent to the insurance capital standard. We should not be following the European model that has increased regulations and less competition, and we should prioritize a model that encourages deregulation, competition, and less government involvement in pricing. So my question is, Chairman, can you highlight the benefits of the U.S. state-based aggregation method compared to the European model regarding market resiliency and systematic risk? And can you confirm that you will push for aggregation method to be deemed equivalent by the IAIS?
I can say this. I do think that our insurance regulatory system has proved itself appropriate and adequate and gotten the job done for a long time, and we don't need to be copying other countries or other regions' insurance regulatory system. I'm a little rusty on the details of the capital requirements, but that sounds right.
But our bottom line is our side works, the other doesn't. We need to stay where we are.
Our side works.
Yeah, thank you. Also in the past, you've stated that banks were well capitalized. We've talked about that today, but now there have been increased conversations about raising capital requirements. Numerous economic studies have found that raising capital requirements for banks will increase borrowing costs for their consumer and commercial customers. And I'm somebody that's owned 50 years. I've never had a day I wasn't out of debt, so I'm concerned about this. And implementing additional regulatory capital requirements will slow economic growth and limit financial institutions' lending ability. So do you believe that raising capital requirements would raise the cost of borrowing and add cost to our economy in Main Street America?
Well, it depends on which banks experience higher capital requirements, and there isn't any proposal to evaluate right now, of course, but it's always a trade-off. You know, higher capital is good in a sense because it keeps banks able to lend during bad times. That's really a good thing. Too much capital, though, probably limits credit availability, so we're trying to strike that balance always.
And this has been touched on a little today, but let me come from a different angle on it. But the Reserve was created to act as a nonpartisan entity that remains separate from party politics. We talked about that. And unfortunately, throughout recent years, the Fed has gotten caught up in politically charged issues like economic inequality, gender and race discrimination, and climate change. Recently, the Federal Reserve Board proposed guidance on managing climate-related risks for large banks, further proving that the Fed is giving in to some political pressure and operating outside its intended purpose and responsibilities. So our country's financial leaders, in my mind, should be focusing on addressing runaway inflation instead of worrying about the financial institutions are doing to monitor climate change. So, and we've touched on this a little bit, but how can the Fed ensure that they're not placing undue regulations and guidance on banks by forcing involvement in partisan green politics? And how's the Federal Reserve ensuring they remain separate from political influence?
I think it's absolutely critical that we do. I mean, our independence is partly founded on the idea that we will stay out of stuff that you have not assigned us to do. And if we're going to wander all over and take on the hot issue of the day, our case for our independence is dramatically weakened. On climate change, I think we do, you mentioned the guidance, and then there are also the stress scenarios, and those are the two things that we've done. We tried to keep those tightly focused on the banks, understanding and being able to manage the risks that they'll run over the longer time periods on climate, and not slide into a broader sort of policy-making role on climate change. And I accept that could be a slippery slope and a moving border. And I just want to say, and I think my colleagues feel the same way on the board, that we're going to guard that border carefully, and we're going to stick to our role and not try to be policymakers the way in many other countries the central bank is out there in the lead with the support of the public doing climate policy. But that's not where we are in the United States, and we're not going to pretend that it is.
I've got some time left, and I'll yield back, but I just want to say as an auto dealer, I'm looking for the first day of that rate cut. Done with that? So, thank you for being here. We appreciate it.
Gentleman's time has expired. We'll now go to the gentleman from